Wall Street, the beating heart of global finance. But behind the skyscrapers and billion-dollar deals lies a history of scandal, deception, and financial disaster. From the 1929 crash that plunged the world into the Great Depression, to the reckless greed of the 2008 meltdown, to secret billion-dollar trades that brought banks to their knees, one thing is clear. Time and time again, Wall Street has gambled with the world's economy and walked away scot-free. How did they pull it off? Who paid the price? And why did no one go to jail? This is the story of 10 financial crises that shook the world, and the billionaires who got away with it. Stay with us, because once you hear what really happened, you'll never look at Wall Street the same way again. The Great Depression, 1929 crash. The stock market crash of 1929 is one of the most infamous financial disasters in history, marking the beginning of the Great Depression. Throughout the 1920s, Wall Street experienced an unprecedented boom, fueled by speculative investments, loose credit policies, and rampant market manipulation. Investors, from wealthy elites to everyday Americans, were encouraged to buy stocks on margin, borrowing money to invest with the expectation that stock prices would continue rising indefinitely. This reckless enthusiasm created a massive speculative bubble, artificially inflating stock values far beyond their actual worth. Banks played a crucial role in this frenzy, engaging in risky lending practices and leveraging their clients' deposits to fuel stock market speculation. Investment firms and bankers often manipulated stock prices through insider trading and pump-and-dump schemes, where they artificially inflated stock prices before selling off their holdings at a profit, leaving unsuspecting investors with worthless shares. The government had little oversight over these practices, as financial regulations were minimal, and many political leaders believed in a hands-off approach to the economy. By the summer of 1929, cracks in the system began to appear. Manufacturing slowed, consumer spending dropped, and corporate profits declined, but stock prices continued to soar. This disconnect between market valuation and economic reality made the crash inevitable. On October 24, 1929, known as Black Thursday, panic gripped Wall Street as a massive sell-off began. Investors scrambled to liquidate their holdings, but with so many sellers and so few buyers, prices plummeted. The chaos continued into the following week, culminating in Black Tuesday on October 29th, when the market lost billions in value within hours. The aftermath was catastrophic. The crash wiped out vast amounts of wealth, pushing businesses into bankruptcy, banks into failure, and millions of Americans into unemployment. As banks collapsed, depositors lost their life savings, leading to further economic contraction. Without federal deposit insurance, the financial system crumbled, worsening the economic downturn. The Great Depression that followed lasted over a decade, with unemployment reaching nearly 25% and global trade grinding to a halt. Despite the reckless behavior of Wall Street bankers, very few faced consequences. Many of the same financiers who contributed to the crisis managed to shield themselves from legal repercussions, often walking away with their personal fortunes intact while ordinary people suffered. It wasn't until the New Deal reforms of the 1930s that significant regulatory changes, such as the Glass-Steagall Act, were implemented to curb Wall Street's excesses and prevent another catastrophic crash. However, history has shown that these lessons were not always heeded, as similar speculative bubbles and financial crises would emerge in later decades. The savings and loan crisis, 1980s-1990s. The savings and loan (S&L) crisis of the 1980s and early 1990s was one of the most significant financial disasters in U.S. history, driven by deregulation, risky investments, and outright fraud. Savings and loan associations were originally small, community-based financial institutions that provided home loans to middle-class Americans. However, in the late 1970s and early 1980s, a combination of high inflation, rising interest rates, and changes in regulations turned them into engines of speculative risk-taking. The crisis began when interest rates skyrocketed due to Federal Reserve policies aimed at curbing inflation. S&Ls, which had issued long-term mortgages at low fixed rates, suddenly found themselves paying much higher interest rates to depositors than they were earning on their existing loans. This created a financial imbalance, putting many institutions at risk of collapse. Instead of addressing the issue with careful financial management, regulators responded by loosening restrictions on S&Ls, allowing them to engage in riskier investments, including commercial real estate, junk bonds, and even speculative ventures completely unrelated to traditional banking. Many S&L operators, emboldened by weak oversight and new deregulations, engaged in reckless lending and outright fraud. Some institutions were run by unscrupulous executives who used depositors' money to fund lavish lifestyles, speculative land deals, and personal business ventures. Fraudulent lending practices became widespread, with S&Ls approving bad loans that they knew would never be repaid. As long as they could attract new deposits, they could maintain the illusion of profitability, at least temporarily. By the late 1980s, the house of cards collapsed. As real estate markets declined and junk bonds plummeted, thousands of S&Ls were left with massive losses. The government was forced to step in, bailing out insolvent institutions through the creation of the Resolution Trust Corporation, RTC, a taxpayer-funded entity tasked with cleaning up the mess. The final cost to the U.S. government, and ultimately to taxpayers, was estimated at over $150 billion. Despite the widespread fraud and mismanagement that led to the crisis, very few executives faced criminal charges. Many walked away unscathed, having enriched themselves while depositors and taxpayers bore the financial burden. Charles Keating, one of the most notorious figures of the scandal, was initially convicted for fraud, but his convictions were later overturned on appeal. Other key players either avoided prosecution or received minimal punishment, reinforcing the perception that financial elites could engage in destructive behavior without facing real consequences. The S&L crisis was a stark reminder of what happens when financial institutions are allowed to gamble with other people's money under weak oversight. It exposed the dangers of deregulation and the perils of letting financial institutions engage in speculative ventures without proper risk controls. Although reforms were introduced in the aftermath, the cycle of reckless financial behavior would continue, paving the way for future crises, including the 2008 Financial Meltdown. The Junk Bond Scandal, 1980s. The junk bond scandal of the 1980s was one of the most aggressive and reckless financial schemes in Wall Street history, built on the promise of high-yield, high-risk debt. At the center of the scandal was Michael Milken, a financier at Drexel Burnham Lambert, who popularized the use of junk bonds, low-rated, high-yield corporate bonds, as a way to finance leveraged buyouts, hostile takeovers, and speculative investments. While junk bonds were not inherently illegal, the way they were used and manipulated led to widespread corruption, fraud, and a financial collapse that cost investors billions. Milken and his team at Drexel Burnham Lambert revolutionized Wall Street by convincing investors that junk bonds were a legitimate way to finance corporate takeovers. His strategy involved issuing large amounts of high-risk bonds to fund the acquisition of companies, often through leveraged buyouts, LBOs. These LBOs allowed corporate raiders to buy companies with borrowed money, strip them of valuable assets, and leave them saddled with debt. In many cases, the targeted companies were forced to downsize, lay off workers, or declare bankruptcy, while the financiers walked away with enormous profits. Milken created a network of traders, corporate raiders, and investment firms that worked together to manipulate bond prices and execute hostile takeovers. One of the key players in this system was Ivan Boesky, a Wall Street arbitrageur who profited from insider information. Boesky paid millions to Drexel Burnham in exchange for early tips on upcoming mergers and acquisitions, allowing him to buy stocks before they surged in value. This form of insider trading became a hallmark of the junk bond era, as Wall Street financiers prioritized personal gain over ethical business practices. As more companies were taken over through junk bond financing, cracks in the system began to appear. Many of these bonds were issued to companies that could barely sustain their debt payments, creating a financial bubble that was bound to burst. In 1986, the stock market began showing signs of instability, and by 1989, several junk bond-funded companies started defaulting on their debts. The collapse of Drexel Burnham Lambert in 1990 was the final blow, marking the end of the junk bond boom and triggering a financial crisis that left many investors with worthless securities. Despite orchestrating one of the biggest financial frauds in history, Milken and others involved in the scandal largely escaped severe punishment. Milken was indicted on 98 counts of racketeering and securities fraud, but through a plea bargain, he served only 2 years in prison and paid a $600 million fine, an amount dwarfed by the billions he had accumulated through his schemes. Boesky, too, served only a short prison sentence despite his central role in insider trading. The junk bond scandal exposed how Wall Street's relentless pursuit of profit could destabilize entire markets and ruin countless lives. It also highlighted the weaknesses in financial regulations, as many of the manipulative practices had gone unchecked for years. While reforms were introduced to curb insider trading and securities fraud, the culture of excessive risk-taking and greed that defined the junk bond era would reappear in later financial crises, proving that Wall Street's appetite for speculation had not been tamed. The dot-com bubble, late 1990s, early 2000s. The dot-com bubble was one of the most spectacular financial manias in history, fueled by Wall Street's obsession with internet startups and the promise of a digital revolution. Throughout the late 1990s, investors poured billions into technology companies, many of which had no profits, no sustainable business models, and in some cases, no real products. Wall Street banks, venture capitalists, and investment firms encouraged this frenzy, promoting risky initial public offerings, IPOs, and hyping up unproven companies to drive up stock prices. The result was an unsustainable speculative bubble that ultimately burst, wiping out trillions of dollars in market value. The foundation of the dot-com boom was built on the rapid rise of the internet. Investors, convinced that the web would transform every aspect of business and society, eagerly funded tech startups with little regard for their financial fundamentals. Companies like Pets.com, Webvan, and eToys raised millions through IPOs despite having no path to profitability. Many firms burned through their cash reserves on advertising, executive bonuses, and extravagant offices, believing that rapid expansion was more important than making money. Wall Street played a central role in inflating the bubble. Investment banks aggressively promoted tech stocks, issuing overly optimistic research reports and assigning high valuations to companies that had yet to generate revenue. Many analysts, despite knowing the weaknesses of these businesses, continued to hype them because their firms had financial interests in the success of the IPOs. This created a vicious cycle. As more companies went public, more investors jumped in, further driving up stock prices. By 2000, the warning signs became impossible to ignore. Many of the companies that had gone public were failing to generate revenue, and their stock prices began to decline. As confidence waned, investors started selling off their shares, triggering a massive collapse. The Nasdaq, which had soared to over 5,000 points at the height of the bubble, lost nearly 80% of its value by 2002. Hundreds of dot-com companies went bankrupt, and investors, many of whom had been promised unlimited growth, lost billions. Despite the widespread losses, few on Wall Street faced any consequences. Many investment banks and analysts had knowingly misled investors, but legal repercussions were minimal. Some firms, like Merrill Lynch and Credit Suisse, settled fraud charges with the SEC for relatively small fines, while executives who had promoted worthless stocks walked away with their fortunes intact. The collapse of the dot-com bubble exposed the dangers of unchecked speculation and Wall Street's willingness to profit from hype, setting the stage for future financial crises driven by similar reckless behavior. The Enron and WorldCom scandals, early 2000s. The Enron and WorldCom scandals were two of the biggest corporate fraud cases in history, exposing how Wall Street's culture of greed and deception could devastate investors and employees alike. These scandals involved fraudulent accounting practices, insider manipulation, and outright lies that allowed executives to hide losses, inflate stock prices, and walk away with massive fortunes, while ordinary investors and workers suffered the consequences. Enron, once considered one of the most innovative companies in the world, was at the center of the first scandal. Led by CEO Jeffrey Skilling and Chairman Ken Lay, Enron used complex financial instruments and off-the-books partnerships to hide billions in debt while reporting record profits. The company's accounting firm, Arthur Andersen, helped cover up the fraud, shredding documents and obstructing investigations. Enron's executives encouraged employees to invest their retirement savings in company stock, all while secretly selling their own shares before the collapse. When the fraud was exposed in late 2001, Enron's stock plummeted from $90 to virtually nothing, wiping out billions in shareholder value and leaving thousands of employees with nothing. Around the same time, WorldCom, one of the largest telecommunications companies in the U.S., was engaging in its own financial deception. CEO Bernie Ebbers and his team used accounting tricks to inflate profits by nearly $4 billion, fooling investors into believing the company was performing well. WorldCom's stock soared, allowing executives to cash out at inflated prices. When the fraud was uncovered in 2002, the company collapsed, resulting in what was then the largest bankruptcy in U.S. history. Thousands of employees lost their jobs and savings, while investors were left with worthless shares. Unlike many Wall Street scandals, the Enron and WorldCom cases actually led to some high-profile convictions. Jeffrey Skilling was sentenced to 24 years in prison, later reduced. Ken Lay was convicted but died before sentencing, and Bernie Ebbers was sentenced to 25 years, though he was released early due to health reasons. Arthur Andersen, one of the world's largest accounting firms, was effectively dismantled after being found guilty of obstruction of justice. These scandals led to major regulatory changes, including the passage of the Sarbanes-Oxley Act, which aimed to increase corporate accountability and prevent similar fraud. However, despite these reforms, the same deceptive financial practices would continue to emerge in new forms, proving that Wall Street's ability to manipulate markets for personal gain was far from over. The 2008 financial crisis, subprime mortgage collapse. The 2008 financial crisis was one of the most devastating economic collapses in modern history, caused by Wall Street's reckless pursuit of profit through high-risk mortgage lending, complex financial instruments, and outright fraud. The crisis began with the aggressive expansion of subprime mortgages, loans given to homebuyers with poor credit histories, often under deceptive terms. Major banks, investment firms, and mortgage lenders fueled a housing bubble by pushing these risky loans, repackaging them into mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, and selling them to investors as safe assets. The entire system was built on the assumption that home prices would continue to rise indefinitely. Banks and lenders, eager to generate profits, approved loans for borrowers who had little ability to repay them. Many of these loans featured misleading terms, such as adjustable interest rates that started low but later skyrocketed. Meanwhile, rating agencies, trusted to provide unbiased assessments, gave high ratings to toxic mortgage-backed securities, allowing banks to sell them to pension funds, insurance companies, and foreign investors who had no idea they were buying worthless assets. As home prices peaked in 2006 and began to decline, the entire structure started to unravel. Homeowners who had taken out risky loans began defaulting, triggering massive losses for banks holding these securities. The financial institutions that had been trading these assets, such as Lehman Brothers, Bear Stearns, and AIG, found themselves on the verge of collapse. Panic spread through the financial system as banks stopped lending to each other, fearing more hidden risks. In September 2008, Lehman Brothers, a 158-year-old investment bank, declared bankruptcy, sending shockwaves through global markets. To prevent a complete financial meltdown, the U.S. government stepped in with a massive bailout. The Troubled Asset Relief Program, TARP, injected hundreds of billions of taxpayer dollars into failing banks, while the Federal Reserve provided emergency liquidity to financial institutions. However, millions of ordinary Americans were not so fortunate. Foreclosures skyrocketed, unemployment surged, and retirement savings were wiped out, plunging the country into the worst economic downturn since the Great Depression. Despite the widespread fraud and reckless behavior that caused the crisis, almost no top Wall Street executives faced criminal prosecution. Banks settled cases with the government for billions in fines, tiny compared to the damage they had caused, without admitting wrongdoing. Meanwhile, many of the same institutions that had driven the economy into the ground continued to operate as usual, with executives receiving multi-million-dollar bonuses, even as ordinary Americans struggled to recover. The 2008 financial crisis remains one of the clearest examples of how Wall Street's unchecked greed can destroy economies, while those responsible walk away unpunished. The Flash Crash, 2010. On May 6, 2010, the stock market experienced one of the most sudden and unexplained collapses in history, known as the Flash Crash. Within minutes, the Dow Jones Industrial Average plunged nearly 1,000 points, approximately a 9% drop, before quickly rebounding. The event wiped out nearly $1 trillion in market value, triggering widespread panic and confusion. While the crash was brief, it exposed how modern financial markets, increasingly dominated by high-frequency trading, HFT firms, had become dangerously unstable and vulnerable to manipulation. At the heart of the flash crash was the rise of algorithmic trading, in which computers execute millions of trades in fractions of a second. These high-speed trading firms operate with little human oversight, using complex mathematical models to buy and sell stocks based on tiny price fluctuations. While this technology was initially promoted as a way to improve market efficiency, it soon became clear that it could also amplify volatility and cause unintended disruptions. On the day of the crash, a large mutual fund placed a massive order to sell $4.1 billion worth of stock index futures contracts. Normally, such a large trade would be absorbed gradually by the market. However, high-frequency trading algorithms detected the order and responded by executing rapid, automated trades, triggering a cascade of selling. Within minutes, stock prices plummeted, with some major companies like Procter & Gamble briefly losing nearly 40% of their value. At one point, shares of Accenture traded for a mere penny due to the market's breakdown. Regulators and market participants struggled to understand what had happened. While some initially blamed a fat finger trading error, a typo that caused a massive order, further investigations pointed to the vulnerabilities of high-frequency trading. The U.S. Securities and Exchange Commission, SEC, and the Commodity Futures Trading Commission, CFTC, eventually determined that a combination of algorithmic trading and market fragmentation had caused the crash. However, there was little consensus on how to prevent future incidents. The flash crash raised serious concerns about the risks of automated trading and Wall Street's increasing reliance on technology-driven market manipulation. While regulators introduced new circuit breakers to temporarily halt trading during extreme volatility, the fundamental issues of high-frequency trading and algorithmic manipulation remained unresolved. No major firms faced legal consequences, and the financial industry largely continued business as usual. The flash crash served as yet another reminder that Wall Street's relentless pursuit of speed and profit often comes at the expense of market stability and fairness. The LIBOR scandal, 2012. The LIBOR scandal was one of the most shocking financial manipulations in history, revealing how some of the world's largest banks rigged a key interest rate that affected trillions of dollars in loans, mortgages, and financial contracts. LIBOR, London Interbank Offered Rate, was supposed to reflect the interest rates at which banks lent to each other, serving as a benchmark for financial markets globally. However, for years, major banks, including Barclays, J.P. Morgan Chase, Deutsche Bank, and UBS, had been secretly manipulating the rate to benefit their own trading positions and make their balance sheets look healthier. The scandal came to light in 2012 when regulators discovered that traders at multiple banks had been colluding to submit artificially high or low estimates of borrowing costs to influence the final LIBOR calculation. This manipulation allowed them to profit from trades based on the rate, while also making their banks appear more financially stable than they actually were. Emails and chat logs revealed that traders openly discussed rigging the rates, with one Barclays trader even joking, "Dude, I owe you big time. I'll buy you a bottle of Bollinger." The impact of the LIBOR fraud was enormous. The manipulated rates affected everything from student loans and mortgages to corporate borrowing and municipal bonds, meaning that ordinary consumers and businesses unknowingly paid the price for Wall Street's greed. Governments, pension funds, and municipalities that relied on LIBOR-based contracts suffered massive financial losses, while the banks involved continued making billions in profits. Once the scheme was exposed, regulators imposed fines totaling over $9 billion on various banks. Barclays CEO Bob Diamond resigned, and several traders were prosecuted. However, the punishments were minimal compared to the damage caused. Most of the banks paid their fines and continued operating as usual. Many of the top executives who oversaw the fraud avoided any jail time, reinforcing the idea that financial elites could manipulate global markets with impunity. The LIBOR scandal exposed deep flaws in the financial system, showing how even the most fundamental market benchmarks could be corrupted by Wall Street greed. In response, regulators phased out LIBOR and replaced it with alternative benchmarks, but the scandal left lasting doubts about the integrity of global finance. It was yet another reminder that when banks manipulate markets for profit, everyday people are the ones who suffer the consequences. The Wells Fargo fake account scandal, 2016. The Wells Fargo fake account scandal was a brazen case of corporate fraud that revealed how one of America's largest banks pressured its employees into unethical and illegal behavior to meet unrealistic sales goals. For years, Wells Fargo employees secretly opened millions of unauthorized bank accounts and credit cards in customers' names without their knowledge. This widespread fraud, which began as early as 2002, was driven by an intense sales culture that rewarded employees for hitting aggressive targets, no matter the cost. To meet these quotas, employees resorted to deceptive tactics, including signing up customers for accounts they never requested, creating fake email addresses, and even forging signatures. Many customers only discovered the fraud when they noticed unexplained fees, damaged credit scores, or accounts they never signed up for. In total, over 3.5 million fake accounts were created, generating millions in fraudulent fees for the bank. The scheme was not the work of a few rogue employees. It was a systemic practice fueled by Wells Fargo's leadership. Executives turned a blind eye to the unethical tactics and even fired employees who tried to report the misconduct. The pressure to meet sales targets was so extreme that some employees reported being threatened with termination if they failed to open enough new accounts. When the scandal was exposed in 2016, public outrage was immediate. Wells Fargo was fined $3 billion by regulators, and CEO John Stumpf was forced to resign. However, the punishment was light compared to the damage caused. While some lower-level employees were fired, top executives faced little personal consequence. Even after stepping down, Stumpf walked away with tens of millions in compensation, while millions of affected customers struggled with the financial fallout. The Wells Fargo scandal highlighted the toxic culture of corporate greed in the banking industry. Despite repeated promises to prioritize ethics and customer trust, the scandal showed that profit-driven incentives often take precedence over legal and moral considerations. While the bank pledged to reform its practices, the scandal reinforced the belief that Wall Street institutions could engage in large-scale fraud with minimal accountability, as long as their profits kept flowing. The Archegos Capital Collapse, 2021. The collapse of Archegos Capital in 2021 was yet another example of Wall Street's reckless risk-taking and lack of oversight, leading to billions in losses for major banks, while its founder, Bill Hwang, walked away relatively unscathed. Archegos, a private investment firm operating as a family office, used a highly leveraged strategy that allowed it to secretly amass massive positions in a handful of stocks. When the bets went south, the fallout triggered a multi-billion-dollar sell-off, exposing deep flaws in the financial system and the dangers of unchecked leverage. Archegos operated differently from traditional hedge funds. Because it was structured as a family office, a private investment firm managing Hwang's personal wealth, it avoided many of the regulations that applied to other financial institutions. This loophole allowed Archegos to engage in high-risk trading without disclosing its holdings or facing regulatory scrutiny. Banks eagerly lent billions to the firm, allowing it to make outsized bets on stocks like Viacom CBS, Discovery, and Chinese tech companies. The key to Archegos' strategy was the use of total return swaps, a complex financial instrument that let the firm borrow heavily to increase its market exposure without actually owning the underlying stocks. By using these swaps, Archegos was able to accumulate enormous concentrated positions without attracting attention. However, this strategy made the firm extremely vulnerable. If stock prices moved against its positions, it would be forced to meet margin calls, requiring it to post additional collateral or sell assets. In March 2021, the bubble burst. Viacom CBS, one of Archegos' biggest holdings, announced a stock offering that triggered a sharp price drop. With its leveraged positions crumbling, Archegos was unable to meet margin calls from banks, forcing them to liquidate billions in stock holdings. The rapid, chaotic sell-off wiped out $20 billion in market value, causing massive losses for banks that had financed Archegos' trades. Credit Suisse and Nomura lost over $5 billion each, while other firms like Goldman Sachs and Morgan Stanley managed to exit their positions before the collapse. Despite the staggering losses, Bill Hwang largely avoided legal consequences at first. Unlike previous Wall Street scandals, no bank executives faced criminal charges, even though their reckless lending practices fueled the collapse. Regulators later charged Hwang and his associates with fraud, alleging that they misled banks about their true risk exposure. However, the damage had already been done. Investors suffered heavy losses, and once again, Wall Street's culture of excessive risk-taking was exposed with little immediate accountability. The Archegos collapse highlighted the dangers of hidden leverage and regulatory loopholes that allowed a single firm to destabilize major financial institutions. It was a stark reminder that, despite the lessons of the 2008 crisis, Wall Street's appetite for risky financial engineering remained as strong as ever. The incident raised serious questions about the effectiveness of financial regulations and whether banks had truly learned from past failures, or if they were simply waiting for the next opportunity to take reckless bets.